All right, good morning, everybody. Welcome to the client support webinar. Great to have you all here. All right, so today is January 24th, 2024. Purpose of the client support webinar is for me to answer any of the questions that you may have. And, I can cover a topic of interest, so I can certainly do that. And you can tell me if there's something that would interest you as well. Also, too, let me know if you're having any trouble with the software or the platform you're using, any feedback like that. I do like to share with other clients in case they're experiencing the same thing, and maybe I can help them with that. And then, of course, whatever you want to cover, there's no such thing as a bad question here. So that's really important. All right, so before I get going, anybody have any questions? And what platform are you guys using? I got TradeStation open right here, but I also have Ninja, okay, as well. All right. Do you have any questions on platform setup or anything of that nature? Let me know. Risk control, that's another important aspect of trading the financial markets. You can let me know on that. And I'll be glad. We haven't covered risk control in a while, so if you want me to cover that, let me know. We can work on things like how to use a trade size calculator, all that kind of good stuff. All right. Okay, so it seems like there's a little bit of an interest here in risk control, trade size calculator. All right, we're just going to pull up a chart. I'll pull up GBTC. It's in a nice correction. I just want to go over this anyway. So if you're in GBTC, we're probably not quite done with the correction. It's probably got a little bit more room to go, and I think it's probably got some more time as well. We're very close to going to a red owl on the daily chart for GBTC. And so when we go to a red owl, then we have a minimum of at least 4, usually statistically, of the indicator change. So that would be red. So what we may have here is the first leg down, maybe an A, B, C, which would mean that we may have quite a bit of time for this correction to unfold. Not really super quick, but maybe more like a few weeks, okay? So just be kind of, ready for that. All right, so we have a couple calculators that we have available, all right? We started out with one called the trade size calculator. Basically looks the same as the risk to reward calculator, which I have in front of you here. And the difference between the trade size calculator and the risk to reward calculator is basically this section of the calculator that gives you the risk to reward and the target profit and things of that nature, okay? So whenever you enter a trade, there's 2 things we look at. We look at calculating trade size, which is how to control our risk. And then we look at, is the trade got enough profit potential to make it worthwhile? And so we actually take a look at those 2 aspects. And the risk to reward calculator covers both aspects, whereas the trade size calculator only will give you this, which is the trade size on each and every trade. So that leads me to my next question. How many people actually have the risk to reward calculator? I think most people are getting that now, but I'd be kind of interested in knowing your situation on that. How many people have the risk to reward calculator? Oh, pretty much everybody, okay? Ooh, all right, we got a big turnout here today. So I'm going to say about 80% of you have the risk to reward calculator based on your feedback. And yeah, some don't have it at all. And then some have the trade size calculator. So kind of interesting. Okay, cool. All right. So if you have the trade size calculator, I'd strongly recommend upgrading to the risk to reward calculator because it does a really nice way of giving you risk to reward pretty easy when you calculate your trade size. The upgrade price, I don't know, is not that much, so you might want to check that out at our store. All right, so let's just kind of run over a few things here. I'm going to, let me just minimize this chart to a point where I can fit in here on the side, the trade size calculator. Okay, give me 1 second, and then we'll scoot that over there. And then I will scoot that there. That way we can always look at it. Now, the other thing I'm going to put up here, which is kind of fun, and I want to change this to GBTC though. All right, now the other thing I'm going to put at the bottom here, all right, is our, I'll put that maybe up here. I'll put that, let's see if I can get that bad boy up here. Okay, so that is our data box. All right, so let's just say we want to go long on GBTC. Now, GBTC is a stock, right? It's an ETF, but it trades as a stock. And so you need to know that in order to tell the calculator, hey, am I trading a stock or am I trading a futures market? So on the calculator here, the first thing you want to do is highlight stock. And this is the same right now. What I'm going to tell you right now is the same for the trade size calculator and the risk to reward calculator. So you got to hit on the stock on the far right there. Okay, so that's the first setting you got to change if you're going to be using that for a stock. All right, the second thing is the margin. Now, in the stock market, what we're referring to here is a margin stock account. So I don't know if you remember when you open up your brokerage account for stocks or equities, they ask you, do you want usually a margin account or an all cash account? And basically a margin account is an account in which they will loan you, the brokerage will actually front you or loan you money, all right, based on the value of your cash account with them. And they'll loan you up to, you know, it depends on your credit and everything else. They could loan you up to 50% of your account. And so if you have a cash account of 100,000, that means they'll allow you to buy roughly $150,000 worth of stock. And so people like that because if it's a bull market, especially if you're traders, it's a great way to leverage, all right, your position and still buy just the underlying asset. So that's kind of cool, all right? So if you have a margin account, if they give you 50%, in other words, they're loaning 50%, then this number here is going to be 150, okay? This is going to be 150. If it's an all cash account, okay, you would put 100 in for all cash. So any amount that they loan you goes above the 100. So if they're loaning you 30%, it would be 130 that you put in that box. So I'm going to put in a margin account of 150, okay? So we'll do that. Let's just pick an account. The next thing you obviously need to put in there, once you have that, is you need to put the account size in. Let's just put 100 grand in, okay? And you can put 100, comma, 3 zeros, and then 0.00 if you want, or you can just put 100,000 in without any of the decimals or commas. All right, so you put that into the account size, and that goes in right here. All right, next we come down to the percent risk. Now, if you're new or just starting out, a rule of thumb is use 2%. All right, now what does the percent risk mean? Let me ask you guys that question. In your knowledge on what risk control is all about using these calculators, what does 2% mean in terms of loss? What are you losing? Anybody? Correct, 2,000 bucks in this case, right? And that's because that's 2% of 100,000. So that means you could lose 2,000 on the trade, and you would only lose 2% of the 100K, right? And that's an acceptable loss based on risk of ruin tables for people that have a system that gives you not even an edge, 50-50 system. If you're losing 2% and you're gaining more than 2% on your wins, which hopefully you will be, all right, then you should be making money, okay? Now, what that 2% does not mean is that you're only buying $2,000 of the stock you want to trade, That's not what that means. So it has nothing to do with buying power. It's how much you will lose if the trade hits your stop. So if your stop is far away from your entry, let me just draw something here as an example in this little box here. So if you enter, let's say at 10 bucks, all right, and your stop is down here at $5, okay, you've got a $5 spread, right, between the entry and the exit. So in order to keep your loss at 2,000 bucks, your trade size is the variable we solve or calculate in order to make that loss only 2,000, no matter how close or far apart the stop is. So let me ask you a question. Which one would have a higher trade size? If you went in at $10 and your stop is set at $5, or if you went in at $10 and your stop equals $8, which would have a higher trade size? We'll call this A or B. Which would have a higher trade size? I'll give you a minute. And let me piggyback onto that. How much would you lose on A if your risk is 2% based on a $100,000 account? And how much would you lose on B at 2%? I'm going to give everybody a minute to think about it. All right, I'm seeing some answers coming in here. Good. Okay, all right. So I'll go through it. I see most of the answers are good. I see some that I'll explain that and you'll see it more clearly here. All right, first of all, the higher trade size is going to be B. Okay, what is the amount you're going to lose on A or B? Are you going to lose more on B, less than B, or the same, or whatever? Okay, how much are you going to lose if the risk is 2% of 100,000? The same, right? So you would lose 2,000 here and 2,000 here. And the reason is because your trade size is going to be different. Okay, this, okay, is going to be a smaller trade size over here. So when you get stopped out at 15, you're not getting stopped out on as high a trade size as when you get stopped out as on B. So the trade size is going to fluctuate in order to keep the loss at 2,000 or 2% of 100 grand. Does everybody get that? Because a lot of times what will happen is I'll get asked, you know, all right, well, what if you have a big triangle for a pyramid trading point, a small one? Okay, this is more risk than this one. The answer is really no, because we're going to compensate the distance by adjusting our trade size. So the loss will be 2,000 on both scenarios because you're going to be trading with more shares or contracts here than here. So therefore your loss, even though it's closer, will be on more shares. So it'll be the same as the less share loss on the other example. Does that make sense? Because that's kind of important to understand how all this works, right? All right, so let's go actually and fill in the calculator for just trade size right now. All right, so let's say we went in on this pyramid down here on GBTC, and the amount we're going to enter here on top of this price bar, and our stop's going to be under here. Now, a couple things I want to do here. Let's open this up even more. Okay. Now, what's the high of this price of this pyramid down here? Let me just see if I can do that. I want to really focus on that one pyramid here. You can see it good. Okay, so let's do that. All right. So the high of the point of the pyramid is this price bar here, right? So technically, you're going to enter one tick over that. Now, if you look on the far right in the data box window, that's 2086. So the way in which the pyramids work is that you enter when prices exceed the point. So it has to go one tick beyond it. So technically the entry is 20.87, isn't it? All right. So where's your stop? Well, your stop is going to be at the bottom of the pyramid, and that's called the base leg down here, right? That's that bottom. Well, this bottom keys off the low of the price bar on the far right. So the low of this plus one tick is going to be the stop. So let's take a look at the low of that. All right, so the low is 19.81 is the exit. That's the stop exit. Now, when did prices go above the point? They didn't do it here, they didn't do it here, they didn't do it here, they did it here, didn't they? Okay, so that was the first spot they did that, right? So what's the low of that price bar? 21.34, right? So ideally, we would have wanted to get in at 20.87, but because the market gapped up, we never got a perfect entry. So now what do? Well, now you have to calculate the trade size, and if you still want to take the trade, you have to do it at the trade size you can get in, okay? So let's play devil's advocate and say you waited until the close and you got in at the closing price. So that closing price then actually is 21.80. So let's use that to calculate our trade size. All right, so 21.80 goes into the entry price. The exit price is going to be 19.81 because that doesn't change, right? All right, we hit calculate, and it tells us we can go in with 1,005 shares. Now let's walk through the calculator a little bit, okay? So notice here we have something called a point value. That's always going to be 1 on the stock market. The only time that changes is when we do futures, and every futures contract have different tick values which correlate into different point values, okay? Now we didn't put the commission in, but you certainly could, okay? Whatever your commission is, you'd want to put that in because maybe your commission will be enough that it lowers the trade size by a share or something to compensate for that, okay? So you want your net amount of risk to be no more than 2%, including commission. So you could put that. All right, now let's see what we got cooking down here. So the dollar risk is $1,999.95. Okay, well, it's just under 2,000. One more share obviously would have put that over 2,000. So we're not going to do that. The calculator is not going to allow you to do that. It has to be 2,000 or below. All right. Now, the cost of the trade is $21,909. So that's how much money it's going to take to trade this. Okay. And that's simply the entry price times 1,005 shares. Okay. So key takeaway is risk has nothing to do with how much the trade actually costs. Okay. That's buying power, cost of the trade. Okay. All right, so let's say we're in here right now at this point here at 1,005 contracts. Okay, great. Okay, so we're off to the races on entry number 1. Well, what happens if we get another pyramid like we did here, and our stop then trails up below this, because that's how we trail stops. So this would be your initial stop, IS, and this would be TS, trailing stop. So now our new stop is right under the flat part of the pyramid, like this one was, and that's the low of this price bar, right? So that low for the stop equals 2485, so it'd be 2484, right? 2484. Now, let me ask a question. If our stop is here and we do get stopped out, did we make money on this trade? Was this a profitable trade? Of course, right? The answer is yes. But let's say we didn't get stopped out and we have our stop here. Do we have any risk now in the trade from a trade risk situation? Do we have any trade risk? No, right? Because if we get stopped out, we're going to make a profit, not take a loss. So the risk from the first entry is gone. Well, what does that allow us to do? What does that allow us to do? Our rules say we are not going to trade any more than 2% risk, if that's what you're using for your risk percentage, right? So you can't exceed that. But you can always have a 2% risk if you want it. Well, that allows you to add into the trend again, because your new stop is here. There's no risk from here. So now we can recalculate a new entry based on the fact that this is almost like the initial stop was down here. We're starting anew, right, on the second position. So this is how you can pyramid into a trend and increase your trade size without increasing your risk. Most people, especially novice traders, when they come into the market, they usually do what they call cost basis. So what that means is you add in to a position to lower your cost basis, but that also increases your risk. And if you've already are at the limit of 2%, then you can't do that. Now, if you go in with 1% here, and you know half of your position here, and the thing trails off, and you're not stopped out rather, but trails off down here, and you want to enter a little bit more, that's fine because you haven't exceeded your 2% risk. But you cannot exceed 2% risk on any open position, and that's trade risk. So let's say you want to add on. If I'm losing anybody, let me know. Let's say you want to add on here. Okay, well, okay. So I've got another pyramid, my stop's under here. So the second position, the add-on is going to be a high of 27.42. So I want to get ready at 27.43 to enter an add-on position. And again, my stop is on this price bar here down at 24.85, so one tick under that. So now let's redo the calculator, okay? And by the way, you can bring up multiple calculators at a time. Just go to the icon and left click on it and hit trade size calculator. It will open up a second, a third, a fourth, a fifth, all right? This case, I'm gonna keep it simple and just keep the one here. All right, so now let's take a look and see what we got cooking for another position. All right, so in this case here, we said we'd enter at 27.43. Well, what price bar did that? Ooh, this one? Nope, that one didn't do it. This one did, okay? So technically we could go long right at the ideal price of 27.43. There was no gaps or anything else. So let's type that in. 0.43, okay? Our stop is going to be below here. So let's put that in. That's 2484. And just be sure when you type these things in, you use like a decimal point. Sometimes you might, mistype and put 27,43. The calculator will give you an error if you did that. And, it's usually a typo. All right, we hit calculate again. Now it's saying, okay, you can add on another 772 shares, which will give you a dollar risk of $1,999. The cost of this trade is $21,175.96. Okay, well, let's see if anybody caught something. What did we do wrong here? What did we do wrong? Anybody? What did we do wrong? Let's go back to our first trade. Okay, so the entry price, all right, ended up being 21.34, right? And our exit price on the first trade was 19.81. We hit calculate, and let's see if I got that right. 1981, 21, it was 21.80. Hold on. So 21.80 was the actual price we got in. Okay, so what did I do wrong here on the second trade? Not this one, on the second one. Anybody? Let's see if anybody caught it. I kind of did it wrong on purpose to see if you would know. I'll give you a second. Anybody? Some of the more experienced traders should understand what happened on the second calculation. Well, what did the trade cost? What did the trade cost? Well, the trade cost $21,909. So I have 100,000, right? But you know what? Now I don't have this amount of money anymore, do I? So I really only have 78,091 available in terms of cash if you were had a cash account, okay? So you have to subtract that because it will affect your margin account too. So you have to put 78,000 instead of 100,000 into the calculator as you use up your account. Does that make sense? So technically, the 2% needs to be 2% of 78,091, not 100,000 on the second trade because we have an active trade. And even if I was going to trade another market, I'd still have to use 78,000 because that's all I have is a cash account. All right, so there you have it. So now, instead of getting 772 shares, we're going to get less because we have less of an account. So on the second trade, now we put in the entry price of 27.43 and a stop of 24.84. And we hit calculate. So it's 603 shares, not 772. Now notice the cost of this trade is 16,540.29. So you need to subtract that from here if you're going to take another trade. And you do that until you run out of money. And that way you don't overtrade or trade beyond your capabilities. So now you have a position that's much larger than your first position. So we took 1,005 shares and then we added on another 603, right? So now we got 1,608 shares. Our risk is only 2%, not 4%, because our stop has been moved to protect our first entry. That's the proper way to add into a trend without increasing your risk. And you could do it again on the third one. Maybe. Nope, didn't quite reach that. So you could only take a 1% risk on that. You can't do it on this one or this one because the rule base that we have is after 3 consecutive pyramids in a row, we don't add on anymore. okay? It's statistically risky. You get a pullback usually after that. But you can see how this can dramatically increase your profit potential, right? Any questions? Now, let's say we're in a big bullish run here, and the PTF, let me just push this back in here like this. So the PTF on the weekly chart, all right, is telling us we should go above here, right? So that top price is what you would put in as a potential target, right? So what's the high? 43.50. So 43.51 can go in there. 43.51. All right. And the initial entry, which was 21.80. And this was 1981 rather. And we hit calculate here. All right, gives us a good risk to reward if I put those numbers in correct. I'm not so sure I did. Let's see, 43.50, that's okay. 43.51. Oh, let's put 100 grand back in here because that was the original starting point. Calculate that. Yeah, so that's pretty significant. Okay, so any questions on that? That's all I'm going to cover today because I don't want to overcomplicate or confuse things. But let me move that down a little bit. But that's how you can go into a market using these tools and maintain your risk control. One more thing I want to say on that, of course, is that if you get a large pyramid, and I've mentioned this before, even though your stop is further away than it would be on a smaller pyramid, if the trade size is too small to make the trade worthwhile, you pass, okay? Just pass on the trade. And what we're talking about here also is trade risk. There is another type of risk called market risk. Does anybody know what that is? Then I'm going to wrap it up. Anybody know what market risk is? Market risk is basically the risk you have with whatever money you have in the market. So even though we are very careful about calculating our trade size, and when we pyramid into a trend and calculate it again, all this, the risk is no more than 2%, but our account, our position is larger. Well, if you get a market risk event that occurs and causes your stop, all right, causes prices to gap way past your stop, well, guess what? All right, you just had a much larger loss than you calculated for. That's called market risk. This is exactly the only way to guard yourself against market risk is by funding your trading account with money you can afford to risk. And this is why no matter how much money you have, you never want to trade with all of it like this, okay? Swing trading or active trading, I'll call it, okay? Because of market risk. Now, the other part too is that if you are trading a crypto and you've got a full position on it, and let's say you want to trade another crypto, well, when you trade that next crypto, you're actually, it's almost equivalent to taking a 4% risk in one sector. So you got to be careful, all right? So when you trade the same sector, you don't want to have too much risk in that sector. And you may want to, decide 6% in the sector is all you want to do. So 3 trades in one sector is it, okay? Because chances are if that trade goes sour, it may affect all the stocks in that sector. So you'll have 3 losses instead of just 1. So you'll have 6% loss. So keep that in mind as well, okay? Different types of risk, okay? So what we talked about primarily here is calculating the trade risk. And from my experience, and I've had gaps that have set me back, and that's the key. If I carefully calculate my trade size, when I have a market risk event that occurs, then it's a setback. It's not a disaster. You can usually recover from it. But if I'm not calculating my trade size, it can be devastating. Any questions?
I'm on with.
Okay, I'll wrap it up here, but I think that gives a pretty comprehensive review of risk and using the risk reward calculator. And I think that's important. You got to know this stuff to be successful in this business. It's one of those slices of the pie that's super important. All right, well, thank you for coming. We'll see you next week, and have a great week. And hopefully it's not too cold where you guys are. It's getting cold, actually, even where I am here in Arizona. So definitely wintertime. All right, we'll see you next time. Thanks so much, everybody. Bye-bye. Thank you. My pleasure. Thank you, Jim. Thank you, Alexander. Appreciate it.